Hello, and welcome back to another edition of Potluck, your everything and anything talk and entertainment TV show. My name is Laura Hartman, and I'm your host. Today we have a wonderful and interesting guest joining us who is from the Loan Depot in Haymarket, Virginia, and with me I have the branch manager, John Clark. Welcome to the show, John.
Hello, how are you?
I'm great, how are you?
Good, thank you for having me.
Oh, thank you so much for coming on. So how long have you been with Loan Depot?
We started actually about 6 months ago in Virginia. It's kind of a brand new arrangement here.
Okay, can you tell us about Loan Depot?
Yeah, Loan Depot actually started in 2008 and is the fastest growing mortgage company in American history. So since 2008, we've become #2 largest independent lender in the United States.
Who's number one?
Quicken Loans.
Quicken. Okay, so you're comparable to like a Quicken Loans.
Well, at least in size. We do things a little differently, but
Okay.
yes, size we would be kind of comparable.
Okay, because I thought, I think I'm thinking of Lending Tree.
Yeah, that's a different
where they
organization.
look for, okay,
Yeah.
Quicken.
Is it started with taxes, and then they rolled over to doing mortgages,
Okay.
and they do all their businesses. 90+% is online,
Okay.
and so we do online as well.
Okay, so you do just mortgages, or what's everything you do?
Pretty much at the moment we do mortgages. We also have the availability of doing personal loans.
Okay.
Right on our website. People can get a check within a week. And then in addition to that, that's not tied to their home.
Okay.
In addition to that, we primarily focus on mortgages at the time.
Okay, and what types of mortgages do you deal with?
Yeah, that's a good question, because there are a lot of different types of mortgages out there.
Right.
And so we do every type that's available in America currently. So that would be conventional financing, traditional loans.
Like a 30-year fixed type of deal?
30-year fixed, and anywhere from 10 to 30 years. Conventional just mainly means that typically you're putting 20% down. Not always, because we have alternative programs for that.
That's when you're buying a house.
Purchasing a home, right.
Okay.
Yeah, oftentimes. And then FHA, which is Federal Housing Administration, they allow lower down payments for folks, oftentimes first-time home buyers, but other folks can qualify for FHA as well. We do VA, which is for veterans. There are several in this area, as you can imagine, in Virginia, both north and south in Virginia. And so we do a lot of business with them. We're the 5th largest VA lender in the country.
Okay.
And then we also do USDA, which is a federal national program. It's designed, it's the same organization, agency, I should say, that does the meat and agriculture, farmland, and so they want to foster and encourage people to live in rural areas.
Oh, so it's farmers.
Yeah, kind of like that, but people even who don't farm, they encourage them to live in the country by giving them 0 down loans.
Oh, wow.
Yeah, so no money down, you can buy a house.
That's great, so I can move out to the country.
And get one
and get
with
a
no cost.
USDA loan. Okay, good to know.
Pretty cool.
Note to self.
Yeah. That's available. And then, so in Virginia, we have a specific program called VHDA. So not USDA, that's a federal, VHDA state program. And they offer 5 different loans, also sometimes with no money down or very little money down. And that can be anywhere in Virginia. Each county has different income limits and qualifications.
So is that for people with limited income?
It goes up to about $143,000 a year. So.
Oh.
Not so
somebody that makes up to that amount can get a
VHDA. Depends on how many people are in your home. The more people in your home, the more you can make.
Okay.
So I was just giving an average.
Okay. So for the VHDA, what are the qualifications for that?
Really just the same as everything else. It's very similar to all the other loans. It's just you need to live in Virginia and be buying a home in Virginia and then meet the income requirements. And other than that, it's really just normal credit requirements, up to 45% debt to income and down to about 640 on credit score. So pretty flexible.
Yeah, and so are there any other limitations? I mean, no limitations whatsoever.
No.
Okay.
It's very
So how come,
great.
I have purchased my house and now I'm, 2 refinancing. So I've never heard of the
VHDA.
Nobody ever offered the VHDA.
Not every lender has the availability. You have to qualify as a lender to work with that organization.
Okay.
Many lenders do have it, yet a lot of times the loan officers maybe aren't as trained on it, aren't as familiar with it, or kind of like in a lot of businesses, you can get stuck in a certain way of doing business and maybe forget about some optional things that you have. So the consumer ends up paying the price because they're not finding out about those things, such as you.
Right. So is the interest rate the same too?
Interest rates are very low. They fluctuate a little bit, but they're in the same range as FHA.
Okay.
A lot of times we're using an FHA product in the VHDA loan as well. So rates are in the high 3s, low 4s right now.
Now, do you share your information of the VHDA loans with like realtors in the area for people buying the
good idea. Yeah, that's a good point. You know, because obviously realtors speak to a lot of people, and sometimes consumers go to them before they talk to the lender.
Okay.
That's changing. About 18% of America has already figured out now that maybe it's better to go to the lender first for these reasons. Find out what's available, and then I can go tailor that to my home.
Okay.
But still, a lot of people do check with their realtors first.
Okay. Yeah. No, I actually, one of my best friends is a realtor, and she actually sold my house to me, but she pointed me in the direction of a mortgage guy before I even dealt with her to make sure I qualified before I even buying the house.
Yeah, good. Yeah.
So
that's a good idea.
But back then he never told me about the VHDA. Anyway, so it's good to know I have options.
Yes, there are more options. Yeah, and we even do renovation loans where people can buy a home that's not in ideal condition. Okay. Finance the home and the renovations all in one loan. That makes it very very good for them, because there are some homes maybe are either in disrepair or have some age, in the Falls Church area.
Or foreclosures.
Or those two. They're not always left in the best condition. Yeah, right.
I mean, I bought my house in 2008, but going to some of the foreclosure houses, it's like I think people mess them up on purpose.
Sometimes it seems that way. Yeah, maybe they're upset,
But back then I was like, that would cost extra money, and I didn't want to deal with the time and everything.
Didn't want to mess with it.
Yes.
And it is something you have to be willing to spend the time, and it is some extra steps, but it can be beneficial. There's usually, depending on the size, there could be a general contractor who's involved in managing the whole process for you. And then the lender usually hires some folks to watch over the draws and the payments to these contractors to protect you and the lender as well. So it's pretty safe and very favorable. It's good in this market where the prices have come up so high. It's kind of hard to find a good deal anymore. Right. And so maybe a good deal could be found in a home that's in less than perfect shape. Right. We finance the renovations. You make it how you want it, and then you end up with a home that you like for less money.
Oh, okay. Now, do you work with companies that do remodeling or home improvement?
We have contractors and other general contractors that we're in relationship with, but the customers can choose their own as well. Okay. There is a process to make sure that they have the right licenses, bonding, and insurance. Sure. Yeah. We want to protect everybody, but any well-qualified contractor could help.
Right. Actually, I have a friend who does home remodeling, and he was telling me that there are certain types of insurances that you should look out for when you are going with a remodeler. Make sure that there's an insurance that can cover your house even after they've gone out of business. A lot of them don't have that.
Yes.
I forget what it's called, but just...
Yeah, no, that's good. You're right. Yeah, there are things that check out, and that's why it's helpful to have a team. You have your realtor, as you mentioned, a good contractor, the lender, title company, appraiser. It takes a lot of people to pull a deal together. Sure. And we as a lender vet anybody who's going to go into that process, whether it's a renovation or a traditional loan. We try to work with full-time, top-tier professionals who are committed to not just earning a profit, but doing the right thing by the customer.
Okay. Now, I have a question. So, like, if I were, I'm not in the market for a house, but say that I was, because, like, the interest rates they've gone up, right?
Well, they did around the election and after for a few months, but around March and still today, the rates are actually lower again.
But what they're at, like 4?
Yeah, right, high 3s to 4.
High 3s, okay.
Yeah.
Okay, but they were lower. I mean, that,
a little bit, yeah.
Depending on which type of loan.
They got down, I think, to about 3.
I get stuff in the mail all the time.
Yeah, 3.5, 3.6, I think was the bottom, right around there. Not that you couldn't get a lower rate on a shorter term loan. You could,
but I think like the 15 years were even lower.
Yes, they were. Yeah. I've done loans as low as 2.5 and 2.6 on the 15-year loans.
Right. Yeah.
And right now that would be in the low 3s. So kind of similar, but a little bit higher.
But either way, say that I was in the market for a house.
Okay. Yeah.
and it takes me a while to look for that house. What happens if the interest rate pops up? I have to what do you do?
That's a great question. I actually had a client who called me last fall and wanted to buy a brand new home here in Fairfax, and a townhome in this area, and almost $1 million, so pretty sizable cost. He called me to get my rates and had gotten some rates from the builder, and the builder gave him 2.625 on a ARM, 7-year ARM, which is great. I said, you know what, I can't do that. I was just a little higher, and they were giving me $8,000 incentive because it was a brand new home. The builder was paying him to take out the loan. I said, you know what, take that deal. So he signed up, went through the paperwork, and they didn't lock in that rate. 4 months later, they're still building the house. He called him back to make sure everything was on the go. It was 3.75. It went up over a point.
Did he not know about an ARM?
Well, that particular lender didn't tell him that you needed to do what you were asking. You need to lock in. When you find terms that are agreeable, you should lock that in, and you have to put that in writing, either in an email or or a letter, or somehow make sure the lender knows that you want to lock that rate in. So then he calls me back and says, this is a big difference on $1 million over a point. That's a big swing in payment.
Yeah.
So what can you do for me? And I got back involved and actually was able to get him lower than that and get him somewhere halfway between. And so we actually locked it down for 90 days at that point.
Okay.
Got him all the way through so that by the time they were done, and they were a month late on building the house, which in new construction that can happen.
It can happen, yeah.
So we still had plenty of time on his lock, and that way his interest stayed the same from the whole time we locked it.
So did he stick with an ARM, or did he go with
He did go with an ARM, yes.
Okay.
Yeah, we got him right around 3%. So.
What would be a good reason for somebody to go with an ARM? I mean, because
yes.
remember, was it back in the 2000s or whatever, where, I forget where exactly in 2000, but people were buying houses, like hotcakes, and the people with the ARMs started going into foreclosure
after the market crashed, right?
Right.
That was one of the issues. There was a lot of different finance options that created some issues. People were taking 100% loans, 125% loans. They were doing option ARMs where you pick what payment you want to pay, and there was a lot of crazy stuff. I call it crazy now. Creative might be a nice word to say. And so that went on in the early 2000s, 2003 through 2006. Okay. And then the market began to crash in 7 and 8, and so those went away. So an ARM is good, though. The problem wasn't necessarily the tool. It might have been how it was structured, how it was explained or not explained, and maybe put with the wrong customer. The idea that I have is that there's a proper loan structure for each client, and that is not always the same. Okay. Everybody's life is different, as we know, right? We have dynamic lives, and we're going through different stages of life. And so my goal is to match the right loan to their personal situation. And right meaning, what makes it right is that it is matched, right? That if they say to me, hey, John, I'm only going to stay in this house 3 to 5 years. And as long as we all feel confident about the market at that time, and that the market will stay up or even, well, why would you tie up a 30-year loan for a 3-year commitment? Right. Doesn't really match.
But what happens if the 5 years goes by and then they can't sell the house?
Right. Good question. Right. Yeah. They still have a 30-year loan at that point. So like a 3, a 5, or a 7-year ARM is really a payment is based on 30. Really what the 3, 5, and 7 indicates is how long, like you asked earlier, how long is the loan locked for? So in that case, the rate would be locked for that length of time. Okay. And at the end of that time, they still have the rest of the 30 years to pay. They don't have to move out necessarily. They can continue with that loan. It would be on a variable loan. So once a year, their rate could change up or down. Could go down. A lot of people actually went down. There's several people who are still on ARMs who got ARMs in 2003. They're still on ARMs in 2017, and they're actually at 2 and 3% rates. Oh wow! Under what the market is today. Right. So you can use them wisely, and you can also misuse them and get stuck. Right. So it really depends, and that's why I take the time to do personally tailored solutions. Okay. Sit down. We've kind of talked about this before the show started today, about taking the time to meet the people, have a conversation, get to know them, understand where they're coming from, and where they think they're headed. Okay. I help a lot of first-time home buyers, and we try to help them in a couple things. One, realize that this is your first home, probably likely not your last home. And therefore, that means there's going to be changes coming in your life. Maybe they are married or engaged. I've helped a lot of single, engaged, or married couples get into homes. And so we take the time to understand that you're probably not going to stay in this home more than 5 years. And in that case, then let's look at some favorable finance solutions that help you get in with limited down payment, low cost, and not too long of a term of obligation, because you're going to probably change your mind. You might have children, you might get married, you might expand your family, you might need to move because of your job, if you're in your 20s.
Or a divorce.
Or a divorce. Anything can happen. Yeah, it can go the other way, right? So there's a lot of things ahead of them in their life. And so what I try to do is talk through some of those, prepare in the best ways we can. And that's one reason I encourage them to use as little of their money as possible. Keep your cash, because cash is king and it gives you options. If you have money in the bank, when opportunity arises, you can strike. If you've spent all your money and it's tied up in a home or in a IRA or 401k to you're 60 years old, you can't necessarily use that money. So you feel captive and you feel stuck and you can't make the best adjustments. So in this situation, I usually encourage them to put 3 to 5% down. Keep anything you have above that. We have negotiated with the national mortgage insurance providers, reduced rates. So, because typically when you don't put 20% down, there's mortgage insurance. And it kind of got a dirty name years ago, and it still lingers a little bit in people's minds that MI is a bad thing, but really it's a great thing. It helps people get into homes that they otherwise couldn't have afforded to get into. They can afford the monthly payment, but the down payment would be tough. And so this allows them to get in the home. And we try to find, as your friend would know, and you've probably experienced, location is the key in real estate. Where is that home? That's the number 1, 2, and 3 factor that drives the value. So we try to make sure that it's a good location, that they put an appropriate money invested in it so that they have some commitment, but not too much. They keep their cash, and that way if they need to move on, I've had a lot of my clients who keep the first home they bought and rent it out and buy a second one. Most people think they have to sell to buy. But because they kept their money, we put them on a savings plan and we keep their payments low and their low fixed rates. They can put the difference every month aside because they have a goal now that 3 to 5 years from now, I want to buy another home and I want to keep this condo or townhome that I bought here. And I want to move into a single family home and I want to make profit every month. I don't know how many people, Laura, that I've met that are in their 50s, 60s, and 70s, probably every single one that I've ever done a loan for would say to me, John, if I had just kept my first house. I have a client that bought a house in Arlington for $15,000.
Oh my gosh.
It's worth 1.2
How long ago was that?
Yeah. Well, 42 years ago.
Wow.
They still have it.
Wow. Good for them.
Yeah, now they have over $1 million asset, right? And they now they've refinanced, as you have and many people do in America, they've refinanced a number of times, but it's been paid off 3 different times. They owe it free and clear, and they have over $1 million asset sitting there. But most of the people I meet wish they had that scenario. Instead, they traded it 3 or 4 times, right? They kept trading in their homes to upgrade, and they think that's the only way they could do it. But there are other ways. So I work with wealth managers in the area and financial planners to coordinate their debts with their loans and with their investments, So a lot of times people separate. They make a housing decision over here and they make investment decisions over here. But the reality is a house is an investment vehicle, right? So I try to make that in coordination. Several clients that I've worked with have worked for the FAA, for instance. That's an example that comes to mind. And they have forced retirement if they're in a comptroller position or a air traffic controller. And so they have a date and an age that they have to stop working in that role. So a lot of them, I've timed their mortgage to end when that job ends.
Oh, wow.
And that way, a 12-year loan or a 17-year loan or however much time we have left. So that way when they no longer earn that higher wage and have overtime and all the stuff that comes with that role, and they may have to move to an office job or a contractor position inside or outside FAA, then all of a sudden they now have either a lower mortgage or no mortgage. So they can afford to continue to live in this area. So that's just an example.
And you let people, when you get somebody to buy a house, or get a new mortgage, you sit down and talk to them about all this stuff?
Yes.
Why didn't my mortgage people do that for me?
Well,
I just was like, here you go.
That's a great question. Here's a simple, straightforward answer, I would say. Nationally, some laws were put in place in 2009 and 2011. Because of the crash, the government stepped in and said, you know what, we need to regulate this business.
I bought my house in 2008.
You did? Okay. Well, I can't answer that one then.
Okay. Right.
I would say since those laws came into play, Frank Dodd being one of those acts that was put into place, the shift began to be compensation was based on quantity and not quality of service. Does that make sense? So you get paid less per deal. So if you want to make the same income, you got to do more deals, which means less time with the consumer. Does that make sense?
Okay, yeah.
For some. And so many businesses and many people in a loan officer position chose to go for, they need the money, so they went for more transactions, which means not explaining all the loan programs, not sitting down, doing it all over the phone and email, which I do a lot of. We use technology, right? I do a lot of that as well, but typically my preference is to meet with the folks in person, similar to what we're doing today, getting to know one another. Understanding, like I said earlier, where have you been? Where are you now? Where would you like to head? And most people don't even ask those questions. They just say, what do you want? 30 years? What's the rate you want? You know, or here's the rate you can get.
Yeah, exactly.
It's kind of short and sweet, right? And there is a transaction involved here, but the transaction, when it's in tune with your plan for life, your financial plan, if you have one, with or without an advisor, makes a lot more sense. And you can then prioritize your life and maybe spend a little less on Starbucks because you know that you're saving for a goal that makes sense, that fits you, that's going to help you progress in life. When you have some of that going on, it's a little easier to feel confident in the person you're working with as well as the plan that you're on.
Wow. So let's talk about refinancing for a short bit because we're running
short on time. Okay. Great.
What is Harp?
Home Affordable Refinance Program.
Okay. Yeah. Tell me or tell us quickly about refinancing options now. And then we're probably going to have to get you back on the show because I don't think we talked about it.
There's a lot more. Harp has changed. It's a government program that was put in place for people who have Fannie Mae or Freddie Mac conventional loans. Fannie or Freddie would have to be the source. FHA has currently not participated. However, I have read that is coming, and that's some of the adjustments. They've made several adjustments so far. They've had different phased rollouts of Harp. Harp 2.0 was there for a while, and now we're on 3.0, if you will. They don't call it that, but they've had at least 3 phases of it. I haven't had a whole lot of clients utilize that lately, so I'm not as up to speed on all the idiosyncrasies, but the design of it was to help people who pay their bills, never missed a payment on their mortgage, are gainfully employed, but their house dropped through the floor on value. And they're stuck. They can't change their loan. Even though they want to.
That makes sense because like I'm not seeing the Harp stuff as much anymore as when the prices did drop. So like I have a friend where her condo dropped significantly. And it's still like barely at value of what it, where she bought it at.
That makes sense. So it is, the need is a little less, but there could be some coming attractions, if you will, or corrections in the market. The stock market's been going up since 2009, so has real estate. So
one quick question, because we are running out of time, short on time. I heard on the radio the other day that the DC area is overvalued on the prices of the houses.
There's a lot of different opinions out there. I would say there's a limited inventory, and DC is the highest it's been in history. The average median household price is $430,000. With several homes in DC proper, well over $1 million and $2 million. And so it is very expensive in this area. It has been going up at about a 4 to 5% rate annually, at least, for the last 3 to 4 years, since about 2012. And that's why I say, maybe end of 2019, early 2020, we could be looking at a negative correction to values, not just in this area, but nationwide.
A negative, I mean,
like
that's
dropping in values.
The house is dropping in value?
That's likely.
Oh.
We've been going up for a while, so it's likely to happen. It won't be a crash necessarily.
So if I'm a homeowner,
yes,
during that time frame, how do you think the interest rates will be then?
That's hard to say because we all thought they'd be higher by now. But likely, initially, they'll probably be higher. That might drive them back down again.
Okay.
They should be climbing over the next year. So I would say the ideal time for buying and refinancing is between right now and June of 2018.
Okay. And if, say, like if, you know, because I've like I said, I bought my house in 2008, and traffic in my area is like horrible as it is
yes.
in the entire DC area.
Right.
And it kind of makes me want to go like further out, you know. So, but you put it in my mind like, well, I could rent my house out, and I've thought of that before. But I'm thinking, well, what if I can't rent it out, and you know something happens, and I'm paying 2 mortgages if I go and buy another house? You know what I mean? So.
I would say to you that would be a reason to come back, because that's a great topic we could talk about.
Okay.
And one other one I'll put a little bug out there would be reverse mortgages. We also do those.
Definitely want to talk about that, because.
Yes.
But that's only for
people 62 and older.
62 and older.
It's a great way to have a house and no mortgage payment.
Can you explain it really quickly?
If you're over 62, 62 or older, you can qualify for a HUD program that allows you to let the equity that you would have in your home pay the mortgage. That's why it's reversing, because typically you're building equity, you're trying to.
But
this would be spending equity.
Okay. But when you sell, if they sold the house to go retire off somewhere like in Hawaii, they won't get as much money back. But their mortgage.
Only if the house went down. What if the house went up?
Oh, true.
Then
that's
they
good.
keep
Okay,
it.
so more for next
more
time.
for next time, yeah.
Well, thank you so much for joining us.
Super.
This is, you know, our final minute.
Okay.
So, where can we find Home Depot or where can
Loan
we find
Depot.
you?
It sounds almost the same. It's Loan Depot. You're right. So it's I'm John Clark, and I'm in Haymarket, Virginia, and we have a branch there. You can find us online at loandepot.com.
Okay.
And you can search all the branches there.
Great, and thank you so much.
Thank you.
And if you're just tuning in now, make sure you catch us on the web at www.potluck-online.org and loandepot.com.
That's right.
All right.
Yeah, thank you very much for having me.
Thank you so much.